So this is a complicated chart, so let's take it slower. Here we notice that there are three rating agencies with two different nomenclatures, and then we're looking at periods under which they default, like 1 year versus 5. And then we'll look at the ratios. These are financial ratios of companies in those categories, risk categories. And the next is upgrade or downgrades within those classes. This particular listing is in order of risk. Investment quality bonds are AAAs down to BBB. The phrasing for S&P and Fitch's look similar, so we put them in one column. AAA, all caps, whereas Moody's right next to it is AA, which is still a AAA, but they use slightly different nomenclature all the way down to junk bonds. Now, what we would expect is what we see is that the 1-year default rate for a AAA is basically 0, as is the 5-year rate. That's why they're highest quality bonds. And then as you go down the quality of bonds, you will see the interest rates go up, right? And these are the additional default risk that each of these bonds would have as it goes from AAA down to junk status, CCC. And then when we look at the ratios, likewise, a couple of them, and we only have two here, return on capital and total debt to capital, basically leverage, we see that the ratings are reflected by those with stronger return on capital, again, downward to ones with lower returns, therefore more risk of not making money and not being able to pay their bonds off. Same thing here, that the higher the leverage, the lower the risk, or the lower the rating and the higher the risk. And then these are percents of upgrades, downgrades, and the yield. And we see that the amount of volatility is again much higher with a lower rated bond, right? All these should make sense to you, that basically the measurement of AAA versus down to the junk is an indicative measure of the quality or risk inside that particular issuer. And that's reflected in the most important metric of all, which is right here, is the yield. So the yield, if you are a AAA, is 2.6, which is essentially how much money costs you, as opposed to, say, a double B is 5.74. So a strong company will pay half the interest rate of a weaker company. And that also makes sense, right? Because strong companies, everyone's going to want to lend to them, so they can then have lower and lower rates as the market bids to buy their bonds. However, a weaker company is a little more desperate, that they are willing to pay even double the interest rate in order to get access to money. So that's kind of the relationship between the different ratings that Fitch's, Moody's, and S&P put out there, compared to these parameters of measurements like financial ratios, like the probability of a change in rating, and finally, like the ultimate price paid for money, which is the yield required by investors. We just expanded that last column, which is the most important column, when we talked about the yield. And then here's when we bring in the notion of spread. Spread, again, is the difference. And here we're measuring spread against one benchmark, which is U.S. Treasury. We see a pretty small spread here for the AAAs, where GE is just a little bit riskier than the government. So there's a half-point spread. And then it just increases pretty dramatically, particularly when we get down to the junk bond status, where there's a 6% spread over the Treasury bill rate. So let's just think of it as cost of money. When we looked at the ratios, we saw two ratios on the previous one measurement of return and the other of debt to capital. But notice that all of these ratios, the ones we've been working with, all are relevant, but we just used these two in the previous example, right? But all of these, if we did each of these particular ratios and calculated them for companies from AAA down to junk, we would see the same pattern. Other factors that you would see on the ratings would be something in the contract itself. Although we talked a lot about the financial parameters of the contract, like interest rate, like the number of years, etc., There are others. Is it secured or unsecured? Secured means that you're pledging some assets as collateral against the bond. So let's say secured by your headquarters building. If you default on that bond, the bondholders can go to court and gain control of your headquarters building and own it. So that's why security is such a big deal. We as consumers are familiar with security too. You buy a house, it's secured by the house. You don't pay the loan, they take your house. You buy a car, the car loan is secured by the car. You don't make payments on your loan, they repossess your car. So that's what security is, right? Asset that is pledged as additional security or additional comfort given to the lender. The next is the seniority, senior versus subordinated. Senior means, as the name implies, higher up, paid earlier. Subordinated, as the word also implies, it's subordinated, it's step below. So senior debt gets money first, subordinated gets money later. So again, the risk level is different, and therefore the price will be different, right? Senior debt will be lower cost than subordinated debt, as it should be, because it has lower risk. Guarantees. There may be guarantees. These are common in partnerships and individuals, but corporation may have guarantees too. You may have guarantees from one company to another. So let's say that there are subsidiaries in a consolidated entity. So one subsidiary may be borrowing money and they may have a guarantor, which could be a sister company, guarantee the debt of their company. So that would be a guarantee. Next would be sinking fund. We talked about these earlier. Sinking funds provide for earlier retirement of some of the debt. So again, that reduces the risk of the bond offering. And debt maturity. How many years? This is one of the 5 factors, right? A 2-year bond would be more likely to be paid off than a 20-year bond, because who knows what's going to happen in 20 years. The risk would rise the longer the bond maturity. And other factors, these are in the industry or with the company as a general credit proposition. How good are they at making money? Are they in a tough regulatory environment? Is there product liability risk, right? We'll see that pretty hugely affecting Samsung right now, as people are fearful that those batteries would explode or catch fire. And then accounting policies. People's aggressiveness in accounting may also be factored in when rating agencies evaluate a company. Next is looking at how these spreads change over time. So we're looking at a period from 2001 out to 2015 out here. And so we see spreads change, and there was a spike because of, again, our horrifically bad mortgage crisis caused a spike. And notice what happens. The safe companies go up, but the spread increases, right? So here they look like parallel almost, but in a really kind of a tumultuous, risky time, this spread explodes like it did right here. There's what we call a flight to quality when the markets are really in bad shape. And the 2008-2009 period was a period where the spreads exploded because nobody wanted anything with risk. We ran away from risk. Whereas in better times, people are back to normal spreads where, yeah, a BAA has more risk than a AAA. It's more manageable. And so we might also look at 1 versus 10 years. We look at what happens with a change in price if there's a yield change. And you see if it's a 1-year bond, it's not a big deal, but the same amount of change in a 10-year bond would have a dramatic effect on the yield to the investors and therefore the price. So there's much more price sensitivity for a longer term bond than there is a shorter term bond. Reinvestment rate risk, this is just the idea that you get money and then when you get it back, then you have to do something with it. So that risk describes what happens to the interest rate environment when you then get money, and can you reinvest it at comparable or better interest rates. And so that's the risk. It's a reinvestment risk of what happens as money flows out. Here is where in a period of dropping or falling interest rates, we would rather be in a long-term bond than a short-term bond, because if rates are dropping and you get your money back, you now have to reinvest in that environment, which is low interest rate. It's really kind of crystal ball time, looking at your crystal ball as to what you look forward and what will happen to future interest rates. If the interest rates drop when you receive money, then you're in trouble. If the interest rates rise when you receive money, then you're happy because you can reinvest and now get even better rates of return than what you just came out of. So that's what we mean by reinvestment rate risk. Yield curve. Yield curve means when we compare the maturity of loans, how does the interest rate behave? And normally there is a yield curve where the longer the wait, the higher the interest rate. And that's what this shows. It's what we're calling normal yield curve, where shorter term interest is lower than longer term interest because of me taking on risk as we go out further.